Most business owners doing 1 million or more have a CPA they trust. And that CPA is doing everything right. The return is accurate, but accurate isn't the same as optimized. Here's what's actually happening. It's not a CPA problem, it's a coordination gap. And at this income level, that gap tends to cost 6 figures a year. Not because anything is being done wrong, but because nobody is connecting the pieces. This video is a plan that closes it. 4 steps, each one builds on the last. Stay with me through step 3. Most business owners can take immediate action on that one. Now this video is for any business owner at $1 million or more. The entity structure, the industry, how long you've been running it, those details do shape the path, but the 4 steps apply across all of them. Here's a situation I see most often at this level. Let's take a hypothetical business owner. Call him Marcus. 1.4 million practice. Same CPA for 9 years. Excellent return, filed on time every April. And nobody had ever connected his compensation structure to his retirement plan, to his spending timing, to how he was pulling money out. When we mapped it, the gap was over $130,000 a year. Marcus isn't unusual. This is happening to many business owners at this level. At the end of this video, I'll give you 7 questions for you to screenshot, worth asking about your own situation right now. Stay with me for that. Let's get into it. Why making 1 million doesn't mean keeping 1 million. Most owners at this level have exactly what Marcus had. A CPA doing excellent work, a financial advisor in place, everything handled. What nobody had done was ask whether those 4 areas, compensation, retirement, spending, and extraction, were actually working together. When they're not, the return is accurate and the gap, it's real. And that gap tends to show up as an effective rate 10 to 12 points above where a coordinated plan could put you. At $1 million plus, that's $100,000 to $150,000 a year not kept. Now you take that across 10 years and compound it out, and it could change what retirement looks like for you. What options exist if the business sells, and what gets built outside of the business. You don't have a CPA problem, you have a coordination gap. Your return is accurate, it's your plan that's missing. And the 4 steps in this video are what closes that gap. And the first one needs to be right here before any of the others make sense. And it's the one most business owners have never had modeled precisely. And that's where step 1 starts. Owner pay, the decision that sits under everything else. How are you paying yourself? Not what you're earning, how that money is actually flowing from the business to you. Because at $1 million plus, the structure of that answer has real tax consequences. For S-corp owners, which describes the majority of business owners at the $750,000 or more income, there's a built-in tension. Take too much a salary and you're maximizing payroll tax exposure on every single dollar. Take too little and you're creating the IRS scrutiny. The reasonable compensation calculation is where that gets managed. And most owners at this level have never had that calculation done with real precision. Let's hypothetically say an owner taking $500,000 net through an S-corp, $250,000 structured as salary, and $250,000 as distributions. The salary carries FICA on both sides up to the Social Security wage base, Medicare above it. The distributions, they avoid that tax entirely. Now consider the same owner, still structured as a sole proprietor, paying self-employment tax on the full $500,000. The difference in that scenario can run $20,000 to $40,000 per year from structure alone before a single additional strategy is applied. That's the kind of gap that shows up when you analyze the return instead of just filing it. And that's the conversation that needs to happen between the planning and the tax side of your team. Owner pay isn't just a compensation decision. It's the foundation that determines a ceiling on every other step in the plan. Retirement contributions, deductions, extraction timing, all of it gets calculated off your owner pay. A wrong foundation distorts everything above it. And the question we're sitting with, has anyone ever modeled whether your compensation structure is the most tax efficient version of itself? Step 2 is where most business owners discover the ceiling they didn't know even existed and how far below it they've been operating. If this has you thinking and you have questions that are better for a conversation than a comment, there's a link below to set up a 20-minute chat. Back to it. The shelter tax. How to move $200,000 off your tax return. The most common answer at this income level, I max out my 401k. At 1 million plus of income, that is the floor. Most business owners don't know the ceiling exists or how far above above the floor it actually sits. The 2026 combined employee and employer limit for solo 401k sits at a 72,000. And with catch-up contributions for owners 50 or older, that number goes higher, subject to change. That alone is often 2 to 3 times what owners assume is available. But that's just the first layer. Layer in a cash balance or defined benefit plan on top, and total annual shelter capacity can reach $150,000 to $300,000 or more, depending on your income, your age, and your actuarial assumptions. At a 37% bracket, the difference between sheltering a fraction of that through a basic plan versus stacking the full capacity represents tens of thousands in taxes not paid that year. Now, every situation is different, but directionally speaking, that's what the math tends to look like. Now, the order of these accounts and how they get funded do matter as much as the amounts you put in. Most owners are running whatever their payroll company sets up years ago and have never really revisited it. The sequence determines how much of each dollar actually stays. The question isn't whether you're contributing to a retirement plan. The question is whether you're using the full capacity your income allows and whether the order is correct. A SEP IRA isn't a bad plan, it's just a default. And at $1 million plus, the default leaves 6 figures of annual tax deferrals sitting on the table. Step 3 is where the plan gets into something most owners never thought about at all. And it's the one that tends to surface the most immediate untapped opportunity. The business spending calendar, strategic versus reactive. This one applies to every business owner at this level, regardless of the entity, and it's almost universally backwards. The typical sequence: a business decision gets made, equipment, a vehicle, technology, a trip, the money goes out. And then somewhere between October and April, that decision gets reported to the CPA. The return reflects it, maybe there's a deduction. The sequence that actually reduces taxes runs the other direction. The projection comes first. The spending decision follows from it. So hypothetically, a 1.1 million owner, late in December, he's looking at a $75,000 equipment purchase. The year's tax picture, it gets mapped. Section 179, expensing, could fully absorb that purchase, but only if it closes before year end. He closes December 30th. Had he waited until January 2nd, same purchase, same equipment, the deduction shifts into a year where the marginal benefit is lower. Same decision, different outcome. This same logic, it applies across equipment, vehicle strategy, home office, health insurance, HSA contributions, professional development, and legitimate business travel. Each category has the right structure and the right time, and those decisions need to happen while the year is still open, not after it's closed. Spending money and spending it in the right time are two completely different financial decisions. At $1 million plus, the difference between those two things has a dollar amount, and it's not small. Most 1 million plus owners have never had Q3 planning conversations. Not because it's complicated, because no one has been setting them up. Quick question, and drop this in the comments. When was the last time a spending decision you made was informed by a tax projection before you made it? Just put the year down below. I read all the comments. And if that question already has an answer you'd rather talk through, there's a link below to set up 20 minutes for a chat. Otherwise, let's keep going. Step 4 is about what happens once that work is done and how you get money out without giving back what that plan created. The extraction play, getting money out without getting it crushed. Most business owners, they treat distributions the same way. Take the money out when you need it. And that's not wrong as a practice, it's just an incomplete plan. How and when money comes out has real tax consequences at $1 million plus in revenue. And most owners have never thought about extraction as a decision at all. So hypothetically, 1.2 million owner who has had step 1 through 3 running consistently for years. Compensation structure, retirement stacks, spending decisions made with a projection in hand. The result, taxable income drops materially. In one of those years, 150,000 Roth conversion becomes possible at a 22 to 24% conversion rate instead of 37%. Not just a tax win for that year, wealth moving into a tax-free structure at the lowest rate the plan created. Whether a Roth conversion makes sense and how to go about converting is something the planning team and the tax team work through together. But that window only exists when the first 3 steps are working. Every single dollar that comes out of the business at a lower rate, moved into a position that doesn't depend on the business surviving or selling, it's a step towards financial independence, not just a tax decision. The extraction play isn't about this year's taxes. It's about the accumulation of what actually gets kept. Now let me show you what all 4 of these look like when you run them all together. A before and an after scenario on a real hypothetical situation with numbers attached. So here's the full plan in practice. S-corp owner, 1.2 million revenue, age 48. Professional services. Before, salary 300,000, distributions 500,000, 401k 22,500. Effective federal rate, 34%. No Q3 planning. Distributions taken when needed. Now, after all 4 steps get implemented, step 1, salary resets to 180,000 based on reasonable compensation for his role in the industry. Payroll tax savings, approximately 15,000 to 25,000 per year. Subject to CPA calculations for specific situations, of course. Step 2, cash balance plan added on top of the 401k. Total annual shelter, $230,000. Tax reduction from additional shelter at this bracket, $60,000 or more per year. That's typically what the math tends to look like. Step 3, Q3 planning conversation added. Equipment purchased, timed, vehicle structure. Health insurance and HSA incorporated. Combined effect, $20,000 to $35,000 in additional tax efficiency annually. Step 4, taxable income is now much lower. $150,000 Roth conversion executed at 24% instead of 37% bracket. Wealth repositioned at the lowest rate the plan created. Now, results will vary based on your income, your structure, your state, and your own circumstances, but this is what coordination planning looks like, and it can be possible. The question is whether those steps are in place and whether they are connected. Before I let you go, here are the 7 questions I mentioned. Take a look at your own situation and look through the questions, and if you've answered no, or you were unsure about any of the questions and how they apply to you, that is the gap, and that's what this video is all about. That's the role I play. I'm a business owner, I'm a certified financial planner, and it's worth being clear about what that means in practice. I don't file returns, I don't prepare them, I analyze them, I identify what's worth looking at, and I coordinate the right people around it. So your CPA, your attorney, your financial plan are all working from the same picture at the same time. Not a couple different people doing different things, but coordination. Decisions get made at the right moment, not reported after the fact. Now that's built around 3 things, and they're what actually define our name, TriBox. We help clients think through cash flow, protect and grow what they built, and when those 2 are in place, approach investment decisions from a position of clarity rather than pressure. Cash, protection, and investments. That's the quarterback role. If this has sparked questions and you want to connect about them, reach out using the link below to set up a 20-minute chat. I'm here to help whether it makes sense for us to work together or not. I enjoy these conversations and I appreciate you watching. Now you have the framework, but a framework without the right strategy inside each step still leaves money on the table. In the next video, I walk you through 8 assets rich business owners never buy and poor ones always do, so you can make better choices with your tax savings dollars. The link is somewhere around here. I'm John Rojas. I'll see you on the next one.